From Morningstar, I'm Jeremy Glazer. The U.S. economy added a very disappointing 38,000 jobs in May. Here with Bob Johnson, he's our Director of Economic Analysis, for a deep dive in these numbers to see if they're as bad as they seem at first glance. Bob, thanks for joining me.
Great to be here today.
So let's start with this 38,000 number. It's way below where consensus was. Even when you add in the striking Verizon workers, it still looks pretty weak. Is this a sign of, or a surprising sign of slowdown in the labor market?
It's not a surprise to us or to our viewers. I mean, we've said for some time that GDP growth has slowed to around 2% or so, and that implies, given normal productivity growth, that employment should grow about 1.5%, or about 180,000 jobs a month. The average prior to today's announcements and revisions was that we were running at about 224,000, well ahead of that 180,000 level. So we needed to get back to that lower level, and we didn't know whether we'd have a bunch of months at 160 that would bring the number down, or if we'd get it all in one fell swoop. And it appears that today that we got it all at once.
Well, let's take a closer look at this number. That 38 maybe is a little bit misleading because you have the striking workers and some other factors you think would make it seem or would make it a little bit higher.
Yes, absolutely. I mean, we had the 38,000, and then you have to add the 35,000 Verizon workers that we talked about yesterday to the data, and that brings us back up to 73. Still not a wonderful number. The manufacturing and goods in general the report didn't make a lot of sense. The hours were up, the wages paid per hour were up. And those are things that don't usually happen in a sector when you're having problems and layoffs and poor employment outlook. So the number really didn't add up. And then in addition, you had the ADP report. And we can say what you want about the ADP report, but one of the areas that they really specialize and claim that they even have an edge over the government is that they interview a lot more manufacturers, a lot more construction sites than the government does. And the government report said we lost 44,000 jobs in the goods producing sector, and they just said we lost a few thousand at the ADP report. So there's clearly a disconnect there between the ADP report, the wages, the hours that just don't add up. And so you could probably add another 40,000 jobs back for probable errors, misstatements, whatever in the goods sector, but that still only gets you to about 113,000 jobs added, which is clearly still a slower number than we've seen. I mentioned the average until the other day was about 220,000, so we're running, even with all my fancy adjustments, running at half of that.
So what other sectors were weighing other than goods?
Well, it's probably a little easier to start in reverse. The only thing that was okay was education and health. Those numbers were probably a little bit above trend. Finance wasn't that far off trend. If you adjust for the Verizon strike, the information services category was pretty much as it has been. So those three sectors were okay, but everything else was disappointing. We knew, let's start maybe with retail, we knew that was going to be a problem given all that's happening in apparel land. But keep in mind, it's not all apparel, but nevertheless, retail is usually added about 40,000 jobs a month. It turns out with the revisions, they didn't add any jobs in March, and we only added 11,000 in the month of, in April, and we only added 11,000 in the month of May. So clearly a disappointment in the retail sector, but you kind of go down the line. The other one, I suppose, that was really surprising was temporary workers. Dropped by 21,000. We've kind of gone along in that category, and it's been a bad year for temp help in general. And it seems like we have these big drops, and then a couple months where it's kind of okay, and then another big drop. Again, as we have all these labor shortages that we've talked about, more and more businesses are moving people off the temp payroll onto their permanent payroll, and temp is certainly not as attractive to a worker who has a lot of options.
With those headline payroll numbers are looking pretty weak no matter which way we slice it. Wages were up again.
Yeah. I mean, that was one of the other inconsistencies in the report. I mean, wage growth was up a nickel. It was up 9 cents the prior month, and I believe it was up the month before that. So we've had a decent increase in that, and we're up 2.5% year over year in a world where we haven't got a lot of inflation, which really is pretty good news for workers, believe it or not. We've averaged a lot worse than that in the past. So again, a relatively healthy number there that isn't consistent with a pretty terrible looking headline number. It certainly wasn't as bad as the numbers seem to suggest.
The unemployment rate came down, but that was mainly because labor participation rate fell pretty dramatically. Do you think this is a mismeasurement? What's happening here?
Well, again, they do come off of two different surveys, and again, the reliability of calling people on the phone, which is how they do these surveys. The number of people that actually pick up the phone is diminishing. It's kind of diminished the quality of this end of the report versus the establishment report that actually counts people with jobs. So this one gets a little bit dicier to calculate. One of the interesting things is that participation had been kind of falling like a rock because of demographic issues. You know, you can always go into the pool when you're young, but you never come out. If you're 90 years old, you still show in the labor force and as a non-participant. And so it's always a tricky thing, and the number had been coming down. And then we had about 6 months where we added 2.5 million people to the workforce, which just doesn't fit the demographic pattern. And this just appears to be an adjustment for that. I wouldn't read very much into that number. I don't think there was any particular reason in May why 500,000 more people would stop looking for work in a period when wages are going up and there seems to be jobs available. It doesn't fit.
So it's safe to say the Fed is not going to look at this 4.7% unemployment rate and say, okay, our job is done, time to start raising rates?
No, I think they have to focus on the headline number a little bit, and I think that's a you know, they can't seem disconnected to the world, and they've said they're data-driven, and this was a poor employment report, and so it'd be consistent for them to keep rates low. And certainly one of the real strengths in the economy lately has been housing, and we wrote last week that it would appear that even kind of a small interest rate increase could slow the housing market a bit, and certainly that's not something we need when there aren't that many sectors that are strong right now.
So it seems pretty safe bet that the June increase 2 weeks from now totally off the table.
I would say it's off the table, unless the BLS comes back and says, oops, that employment report was a mistake.
So in the real world, then, what does this report mean? Are we going to see a big dramatic slowdown in GDP growth? Is this a sign that we're kind of headed towards some economic turmoil?
Well, I think the GDP kind of leads what happened in employment. And you know, we've been wrong. We thought the shoes would fall earlier in this, and they haven't. We suddenly got a kind of a 1 month catch up. I mean, we had some numbers where we added 300,000-400,000 in the fall. It just didn't make any sense. And you know, now we've kind of played catch up on those numbers a little bit. So I think that the GDP growth rate probably has slowed. We ran for 2 years in a row at about 2.4%. I think a number looks more like 1.9, 2% for this year, even if we get a 3% growth number in the second quarter, which is what we're looking for. So even with that, I think we'll still be lucky to get to 2% for the full year.
So no change to your estimate?
No change to my forecast, but again, it's a pretty conservative forecast at 1.9 to 2%, which is no different than it has been over the last 4 quarters on a year-over-year basis. So things aren't falling apart. It's just that employment kind of got ahead of itself, and now we have to back off.
Bob, thanks for your analysis.
Thank you.
For Morningstar, I'm Jerry McGlazer. Thanks for watching.